Welcome to tonight's webinar entitled Implications of i-Sinar on the Stock Market. Okay, this is brought to you together with Affin Hwang Investment Bank. All right, we want to thank Affin for sponsoring this event and brought to you guys. All right, so as we all know, recently the i-Sinar application to withdraw your money from EPF is now without any conditions, right? And I believe that the process was quite fast, and I was quite surprised. There are a lot of people that I know of who have actually applied, and they got it like 2 or 3 days after the application. So, of course, we are now as investors, we were wondering how is it going to impact the stock market, right? And whether it's going to be positive or negative. But what we're going to do today, again, is we are not going to provide any investment advice, but we are basically sharing our research on the implications of i-Sinar on the stock market. So you'll be covering some of the sectors, and Alvin will be presenting to you guys in a short while. All right. I hope that everyone can hear us. If you can hear us, can you say yes? And maybe Alvin, you can also say something.
Yeah, mic check. Good evening, everybody. Can you hear us loud and clear?
Yeah, can you type yes on the comment section so you can hear us?
Happy to be back. This is a segment that we run on the third Wednesday of every month, brought to you by Affin Hwang Capital. Yeah, okay, yes, okay, thank you. Tommy and Bokong.
Good evening. Hi, Jatinder. Hello, Arul. Hello, Leong Kin Sing, Rahalat, CH Ang, Jason, Arul, Awai Peng. Thank you so much. Thank you so much for your text. Now that we know that you can hear us. All right. We have actually got a lot to cover. So I think without further ado, we're going to start the presentation. And then if you guys have any questions, you can type it down, and we have towards the end, or maybe even during the presentation itself, if we think that your question needs to be answered, we'll answer your questions. All right. So thank you once again for joining us. Thank you guys for spending your time tonight. I'm sure that a lot of you will also want to know where do we go from here, right? And today our Prime Minister has also just announced another stimulus package for the economy. All right, maybe we're probably going to have that session on that next, but we'll see how the implications of i-Sinar on the stock market first, okay, and see which sectors we think may benefit from this. All right, so Alvin, over to you.
All right, thanks so much, Benny. So what we're going to be doing is really going to start big picture and then dive down. So we will be talking about. We're going to use a few case studies here that. We think from the withdrawal that, these are the sectors that you should be, looking at, or these sectors that are likely to be impacted. Of course, then Benny will come in after each of these case studies to really look at the stock prices as well on a technical perspective. All right. So again, if you guys have any questions at any point in time, happy just punch it in. And then when we have our Q&A session, I think we're gonna have a session where we're gonna ask them something, right? We're gonna do a poll. Is all right?
Yeah.
Yeah.
And don't worry, the slides will be provided to you guys, but you have to wait until the end of the session. Then we'll give you the link to download the slides. All right?
Yeah. I think we also have something very special for you guys. So if you guys sit back and stay till the end, we actually have compiled a list of stocks and the percentage in shareholding that EPF actually owns, right, in the whole stock market. So from A all the way to Z, the percentage and the value. Because I guess the question here is, will this i-Sinar withdrawal have a negative or positive impact on the domestic equity market, right? So that's something. So if you stay till the end, we'll send you guys the link. We actually dig through all our data to actually compile all that for you. So all that is available free to you. We will share the link with you at the end of this segment. All right. So without further ado, let's get started. Let's take a look. So let me just see if I can add this in. Okay, great. Okay, so very quick one. This is a disclaimer. Okay, so this is purely educational purposes, and we will be talking about stocks. So should you require any financial advice, it's not meant to be financial advice. It's really educational for you guys who are investors. Our goal is to make sure that you become a more informed investor, right? Through data as well. So let's take a look. And of course, when we did this project, there was a lot of work behind it. And also, we had to make a lot of assumptions, right, based on whatever data we had. And of course, these assumptions are really purely assumptions. We're going to see how far we are from some of these estimates. So we actually ran a segment similar to this in March 2020 after they announced the second announcement on EPF. That was really during the first full-on MCO. And our estimates, some of them were very, very close, like within 5%. Some of them were about 50% plus minus, so a little bit further away. All right, so let's take a look at what we have. So let's look at what's in the news firstly. I think all of you guys would have definitely heard about i-Lestari and of course i-Sinar. And why are we thinking that this topic is actually quite topical to cover? Is this. If you think about this, EPF is really the largest shareholder, one of the largest shareholder in our local equity market. So they own roughly between 16 to 20% of all total market cap in Malaysia. So if these guys have to move their portfolio and let's say with sell some of their assets to actually enable some of these withdrawals to happen, there should be, I guess, logically thinking, there should be some impact on the stock market. So we're going to use some of these stats and trying to figure out whether whether there will be a massive impact or not. So there were a lot of news that's kind of flown around, and when we thought about doing this, we're saying that people must be curious, right? Let's really deep dive and figure out what are some of these major actions. So the amount is actually quite large, yeah. The amount that has been withdrawn, or the amount of liquidity that has been pushed into the market is sizable, and I mean sizable, it's as sizable as the 6-month moratorium that we had in 2020. So it is quite sizable, over 100 billion ringgit into the market, right? So where is this 100 billion ringgit going to be going? So let's take a look. So just to update you guys very quickly, of course, they've called it i-Lestari and i-Sinar now. Basically, i-Lestari is basically the first announcement that was made. That was back in April 2020. And that was a withdrawal of 500 ringgit, right? Maximum for 12 months, so it's 6,000. That wasn't a very, very massive impact. But the real massive impact one that we're seeing today is actually the i-Sinar withdrawals from your account 1. Now, so if you're a Malaysian and you have an EPF account, your account 1 represents 70% of your retirement savings, right? So that's very substantial. Account 2 represents 30%. So the maximum withdrawal is 60,000 ringgit or 10%, right? So 60,000 it is the limit. So if you look at the number of members they have at EPF, if you multiply by 10%, it is a very, very substantial number. So we'll talk a little bit about some of the estimates. Of course, these are estimates that has been announced, and of course, all these analysts are trying to figure out, but really we won't know the final number until it's actually done and dusted, which is the closing date is 30th June, right? And if you look at the kind of withdrawal, let's look at sort of the lower number and probably the maximum number, right? So later we're actually going to have a poll as well to kind of get a gauge of where we're at this point in time. Now, there were also recent announcements that were put out in the news, right? That it kind of put a little bit of I would say a little bit of downside or a little bit of fear or uncertainty or doubt that EPF are putting their buildings up for sale, right? So they've listed at least 7 assets that they want to sell. We just want to debunk some myths here, because actually in 2014, part of their real estate portfolio, they were actually going to build or develop in Damansara in Klang Valley here. And actually it's in Sungai Buloh, right? So if you look at it, the news makes it look quite scary, but really when you look at this, this was already planned 6-7 years ago. So the sale of the assets actually has nothing to do with them needing liquidity so much. It so happened it coincided with the i-Sinar announcement as well. Okay, so really they are selling all their buildings and they're moving to their new HQ in Kuasa Damansara, which is they are the master developer. It's part of their portfolio. Okay, now the question is, these are what experts are saying, right? So we have, a couple of news announcements that, some might put it at 56 billion, right? So if you remember last year, our 6-month moratorium basically estimated put about 100 billion liquidity into the market. Okay, so some experts are saying it's 56 billion. And based on the calculations, this is how they've calculated it. But remember, these are all based on assumptions, right? Very important, because it's the probability of withdrawal case, which means how many people actually go in and withdraw. So it's not automatic. If it's automatic, I think it's quite easy. It is based on your request. So if you go online and fill up a couple of questions, in less than 2 minutes, you actually can withdraw up to 10% of your account one. Now, this is also something that has been announced. As you all know, in 2020, EPF actually announced a 5.3 or 5.2% dividend to all EPF shareholders and 4.9 for the Sharia shareholders, Sharia members, right? So where they have actually estimated these numbers, they are quite staggering, mind you. It is 130 billion from all the EPF schemes that have come up so far, right? So this is actually even more than a 6-month moratorium. So we should stand up and really look at it and realize where's all this money going to be going, right? So the i-Sinar portion is estimated to be 90 billion, right? So that is almost equivalent to the 6-month moratorium. Now that's excluding the 20 billion from the i-Lestari withdrawals, which is the 500 over 12 months, and also the 13.6 billion, because EPF, the government announced last year that employee contribution rate can drop by 4%, right? That put another 13.6 billion back into the economy as well. So if you kind of add it all up, you're looking at close to about 130 odd billion, right? So very, very substantial here. So EPF is already readied, right? This amount that is ready to be released in the economy. So the question here is, will they be what part of the assets will they be liquidating, right? And how will it affect you as a shareholder? So let's kind of look at EPF very quickly and try to just figure out where is it that how is it structured, so we can actually have a look, right? So this was something we covered on the 23rd of March 2020. I just want to share with you guys a perspective of how you would want to analyze this, right? So this is because EPF has only issued their annual report up to 2019. So these are the 2019 figures that I have to use, right? 2020 is still not out yet. Now, so if you look at 2019, this was pre-COVID. If you look at the first table right there, if you look at from a cash flow perspective from EPF, if you look at total contribution was 75 billion for the year, less all the withdrawals, 44.8 billion. Actually, there was a net contribution every month of net contribution for the full year of about 31 billion, which brings it about 2.6 billion per month, right? Now, mind you, of course, some of our members have also lost their jobs. Some businesses have closed down. So this number is expected to be definitely lower. But all things being equal, actually, EPF by itself, actually, they are cash flow positive every month, right? So not really needing to liquidate any assets, which means that the assets can keep growing from there, which they have, right? And now on the first announcement, which was 27th of Feb, on the 4% reduction of contribution, actually the net amount actually from 31 billion, actually the estimated reduction we estimated back then was 1.1 billion. It came very close. It was about 13 billion. And really, even after the 4% reduction, EPF was still cash flow positive, right, by 1.5 billion. Okay, we have a comment here from Chang Ki Chung that you cannot hear.
The rest of you guys, can you hear?
Yeah, can you guys hear us?
Just want to make sure maybe Chang did not put on his volume up.
Yeah, you guys can hear? All good? Yeah, can the rest of you guys hear?
Yeah, can you just say yes in the comment section?
Yeah. Yeah.
Okay,
okay.
Ken.
Thanks, Su Chin, right?
All right, thank you. Thank you, Raymond. Thank you, Lily.
Okay, so Chang, maybe check your volume again.
Yeah.
Thanks. Now, so this was 2019 numbers again. So really, even with the withdrawal amount, which is the i-Lestari, assuming everybody withdrew, actually there was just net monthly contribution of 0.1 billion a month, right? And actually, really, when you put it into perspective, 0.1 billion multiply by 12, you're looking at 1.2 billion. So EPF's portfolio is about $1 trillion. So 12 billion is actually 1.2 billion is actually a very, very small number. All right. So really, they didn't really have to move their portfolios too much, right, to accommodate for the 4% and the 500, right, the i-Lestari. Now, in fact, this is being data driven here, and I just want to give you guys an idea. So we would assume that they would start liquidating assets, but actually they didn't need to, right? So if you look at 31st December, based on Bursa's market cap, if you take your main market and your ACE market added together, it's 1.7 trillion. That's our Malaysian market, right? EPF equities alone in the domestic equities represented about 13%. Now that is a very substantial number, okay? And if I move to 2020, you've actually noticed that actually EPF is a net increase, right? Not a net withdrawal from the domestic equity market. So their numbers actually went up to 16%. And on top of that, our market cap has actually increased to $1.8 trillion. So if you kind of combine these two numbers, I just want to give you guys an idea. Is that actually the net amount 2019 versus 2020, you're looking at about 60 billion ringgit, right? So even if you factor in the increases in share prices, they actually net actually putting more money into the market as well during this period, right? So from 15 to 16%. So it is quite substantial. Now, if we look at the breakdown of their portfolio, you're going to see quite obvious what happens here, right? On their portfolio, actually 50% is fixed income, right? Your bonds, which means that they pay you every month, right? Equities is 36%. But of the total portfolio, and of course, real estate is 10%, and then money market is the rest, right? 3-4%. Now, when you actually look at the asset allocation in 2019, actually 70% is domestic, 30% is foreign, right? And in their actually press release statement, they said that their foreign equities have done tremendously well. And I believe if you're in the US market last year, I think you too would have done pretty well yourself as well. And that contributed almost half of the income for 2020, in fact, right? Equity returns, right? Now, if we fast forward and look at 2020, 1 year later, you're going to realize straight away that they've actually reduced their fixed income and they've actually increased their equity portfolio, right? So actually, if the initial idea was to think that EPF was going to sell down shares to kind of pay out i-Sinar, it doesn't seem like that is probably the case. In fact, what we're seeing here is that the reverse. In fact, they're putting more money in the markets. Actually, they are liquidating from their fixed income instruments instead. Of course, being in real estate can be quite illiquid. Okay. Now, if we look at the difference here, the difference is actually a stark 25% increase in just domestic equities, right? This is not international equity. So it is about 60 billion increase from 2019 to 2020, right? So if we kind of really dig a little bit deeper and figure out, look, i-Sinar is very much dependent on the members withdrawing money from the portfolios, right? And which are the members actually with the most amount of money, because they will be the one that carries the most impact, right? And that's how we kind of follow that trail, right? That money trail, right? So if you look at the Gen X, right? So if we split our members in terms of generation or EPF members by generation, so you get Gen Z, you got millennials, you got Gen X, baby boomers, and of course the silent generation. You're going to realize that baby boomers in that space or the late boomers, actually a lot of them have already hit retirement age. Then actually most of them have taken out their savings. Now you're going to see 66.43% actually belong to those in the 36 to 55 range today. So this is your Gen X and maybe your very late millennials, right? They make up a bulk of it. So if you take out your millennials and your Gen X, they're actually almost 80-90% of the total savings in EPF today. So now, of course, this is really a chart where we to summarize some of these details that we've done here. There was a lot of work that kind of went through the background. My team and I, we went through a lot of data here. But of course, if you guys want to analyze it yourself, you can. It's actually here. We're going to show you guys a We're going to show you guys, give you guys a link where you actually can download some of these slides later. All right. So if you can see, the Gen X is a very, very big percentage of total allocation. Of course, this is based on 2019, right? Now, what is interesting is this, right? We're seeing a very clear trend. The question here is that if a lot of the guys who will give the biggest impact in terms of withdrawals will be your Gen X, people in your Gen X generation, right? And if you look at this, based on your 5-year withdrawals by categories alone, right? Actually, you're going to realize that a big bulk of yearly withdrawals is because of retirement. And of course, that is to be understandable because the very early members are now retiring, right? Actually, one of the, apart from housing, the second largest withdrawal actually is actually members' investment scheme, right? Members' investment scheme, right? Which means, right, a lot of members actually voluntarily take out their money to put it into other investment schemes that are approved by EPF, but it's actually not run by EPF itself. So if you can look at, I'm just going to highlight it here, you're going to see that 5 billion, 6 billion, 8 billion, 9 billion, just before the pandemic, or 2020 was a drop, but really you can see that number going up. So we're seeing that we're making a few assumptions here. We're just making a few assumptions here. But we have to be, there must be a basis of why we make some of these assumptions. That likely a lot of the amount that is going to come out from the i-Sinar segment may actually flow back into the equity markets or the fund market instead, right? Indirectly, right? So this is something that is an assumption that we make, right? Because don't forget, 100 billion ringgit or 90 billion ringgit for i-Sinar, it is very, very substantial. Okay, considering our whole market cap is 1.8 trillion. Now, so this is actually the chart. You can see that almost every year the withdrawal percentage, of course, number one being for retirement, that is the obvious one. But apart from the retirement part, almost at the peak in 2018 was 20% withdrawal into their own investment scheme, right? Of course, approved by EPF, right? So that's quite a clear trend that we're actually seeing. Now, most of us would think that the stock market has really hit an all-time high, and that the markets are really expensive, and maybe we're a little bit jittery. We should be out of the market. I think those are concerns that I hear right now that's on the ground. But if we look at the data points, actually they're kind of telling us something very, very different. Now, if you just look at this is purely based on market cap and market cap alone, right? On Bursa Malaysia, just the main market and the ACE market. So we took out structured warrants and LIQUIDITY because they're also quite small, right? In the whole total scheme of things. If you look at January 2019, February, March, April, May, June, July, right? Up to June of 2019, this is pre-pandemic. The total market cap was about 1.7+ trillion. Okay. Now, of course, it started coming down in 2019 and we hit the low in the first MCO, which was March 2020. Of course, the market have rebounded, definitely. But purely from a level of market cap alone, right now, today, we are only 6% above where we were in January 2019. Right? I just want to put it into perspective because I think sometimes when we say all-time high, yes, a lot of stocks have hit all-time high. I don't deny that. But really, if you look at the totality of the market, and if you think of the market cap, meaning market capitalization, that means you add up the price multiplied by total number of issued shares, and you add it all up, and you actually can figure out your market cap. If you take that market cap, you're going to see Malaysia is largely dominated by your big or your index components, right? Your index components are the guys that are the biggest market cap. Namely, Maybank is the largest market cap stock in the Malaysian market, right? So actually, if we're looking at the stocks that really moved, it doesn't seem like the major composite index stocks really have really gone anywhere. This 6% increase is actually quite marginal, if you ask me, compared to January 2019. And this is after the fact that we've had massive stimulus, okay? I think not just in Malaysia, globally, we've had massive stimulus packages, right? We talk about a 6-month moratorium, which is 100 billion, and now with i-Sinar, add another 100 billion. We're looking at 200 billion, right, in a very short time frame. So we're actually only seeing a 6.4% increase from January 2019. Okay, and this was pre-pandemic. So I think because EPF has already come out and said that they've already allocated 130 billion for withdrawals. That's already been earmarked. We think, well, this is my personal opinion, right? Of course, it's not financial advice. Just purely looking at some of these numbers and them increasing their stake in the equity markets, considering the fact that we're also at historically low interest rates, right? Historically low interest rates. And we're likely to be historical low interest rates, for an extended period of time, because this is really, a global event. This is not just only in Malaysia. We're thinking that it's likely that if they needed to cash out and withdraw money from their portfolio, it may come mostly from the fixed income, and of course they also have the cash element in their portfolio. My initial estimate is probably only a 30 to 50 billion withdrawal, which is, in the bigger scheme of things, at 1 trillion. That's their, as of 31st December 2020, it's only 5% of their total portfolio, right? It is not as substantial as we think it is, right? Now, so the question here is, with a 90 billion going to go to, all these members who are now going online, clicking and literally withdrawing, and I must say that they are very, very efficient as well, because I personally did mine, and I think it took 2 days before money was in my bank account, right? So, and the initial payout is actually the most, and it's spread out over 6 months as well. So if you look at what's going to happen is that now the market's got new, fresh liquidity again, right? The question is, this is slightly different because this is not money printing. This is really just extra liquidity in the market, right? So what happens is that, we've got millions of members now with extra income or extra savings that they couldn't previously access. The question is, where will it likely go, right? So we got 100 billion here, right? So we believe that because it is mass scale, it's not stuck at the banking sector, which means that banks will decide whether to lend or not, which was really what happened in the 2008-2009 financial crisis. Right now, we're seeing broad-based liquidity, which means, and it makes sense to stimulate the economy this way, because this will have a multiplier effect, right? Of course, more than 100 billion, right? So what we do think that the sectors where you're talking about broad-based stimulus, likely these are the few easy ones that will likely be impacted, right? Retail, right? So we've been locked down. We got to think of the fact that we've been locked down. We cannot go shopping. We cannot go out for the last 6 weeks. I think it's less than 10 days ago that MCO officially lifted in the Klang Valley where we are, and I think across Malaysia. A few things that will happen, right? Retail is a possible comeback, and I'm going to show you guys some of the data to actually show you why retail is likely coming back. A longer term or mid to longer term one is probably property and construction, right? And the third one could be banking and financial services, right? So the savings that could be put up was actually perhaps to reduce credit card debt. If someone decides to put a down payment on a new car, that would also boost the banking and financial services in terms of automotive loans. And of course, retail brokerage as well, right? If what we're seeing those statistics before, that the trend is that a lot of the savers are taking out money and investing in themselves, which means that they think they can do it better themselves, right? So we might see more people getting into the stock market, even more retail participation than where we are today, right? Of course, if you follow that trail, of course, you talk about malls, you talk about retail chains, you talk about motorcycle or car sales as well, and of course, those who provide loans in those segments as well. So today's segment, really what we're going to be doing is we're going to really deep dive and look at some of the retail segments and really see how they're doing, right? And I want to show you guys something interesting in how retail is actually recovering, right? And you can actually find it online as well, the information.
Okay, Alvin, maybe before you go further, since we have almost 300 people here, we can actually have a poll to sample out about the i-Sinar withdrawals, right? Because 130 billion is basically earmarked for everyone if they withdraw, right? So we have 300 people. I think we have good enough sample to have a gauge of the withdrawals, right? That's going to be taking place. So we're gonna come up with 2 polls for you guys. You can just answer it. It's going to come on your screen in a short while. The first poll is going to be number 1: Will you withdraw, or you have withdrawn already, right? From your EPF. Okay. The second poll will be about what are you going to do with the withdrawal, right? Are you going to invest, or are you going to spend, or if these are for those who want to withdraw or already withdrawn, right? So the poll is going to come up to your screen. I hope that all of you guys will participate. Then we will actually have a gauge, right? Because I think we will have almost 300 over people now logging in. That will give us a good sample size. All right.
Benny, sound is a bit soft, is it? Can you guys hear Benny well?
A bit softer. Okay, with that, maybe Alvin, you can also look at CH Ang's comment over there. It says fixed income for EPF in 46% in 2020 is low, and I believe they will sell the equity to increase their fixed income percentage, being a fund meant for Malaysian retirement fund. But of course, you said that it's probably going to be more for equity, the fixed income liquidation rather than equities, right?
Yeah, I think you're right. It is an investment fund. Typically, EPF does about 30-35 in terms of the equity portfolio portion. They always leave some in cash, and they always have, maybe up to a decade ago, they had real estate as well. So if you look at it, CH, these are assumptions we're making. These are really purely assumptions we're making, right? It could be they could remain in the equity market because interest rates are really low for fixed income, because they have to withdraw about 50 billion, right? They're about plus minus 50, maybe 60 billion, right? Where are they going to get that 50-60 billion? Are they going to sell all will this pare down their equity portfolio, or they pare down their fixed income portfolio, right? The question here is, at which point are they weighted more towards? Are they going to weight more towards selling more equity, or they're going to sell more fixed income, right? Because if you look at the returns or the dividends that was actually announced in 2020, actually almost half of those returns came from equity markets, right? That 5% return that you gotten, all you members here, it's almost 50%, and that's based on 2020 numbers, right? So if interest rates go even lower, right, or maintain much lower, and don't forget, they're not just domestic. I must highlight to you, right? 30% of their portfolio is in foreign assets across all asset classes, which means if you are holding any US dollar bonds today, your returns are actually very, very minimal, right? 30% of a 1 trillion is 300 billion. Okay, so it is quite substantial. We must understand that. Of course, that's spread across classes. They didn't do a breakdown on foreign equities, right? So again, assumption, right? Let's kind of wait 12 months later and kind of see where that is. But we know for a fact that there will be some form of liquidation, but the impact on the total portfolio does not seem that big, right? It doesn't seem that big, even on a worst case scenario basis, right? It's really 5% or less. But again, that depends how many people actually click on i-Sinar, go on the website, and actually do their withdrawal. Okay, and that's until 30th June anyway. So I guess they will definitely make a public announcement, and we'll see the actual impact. Yeah.
All right. Okay. I hope you already answered the first poll. We're going to come up with the second poll, so you just answer those questions as we continue with the presentation. All right. Okay, Alvin, maybe you can go on.
Yep. Okay. Cool. So we're gonna do a deep dive into the retail segment in Malaysia, because if you're gonna be broad based, everyone's got extra cash. The question is, will everyone go shopping, right? And will some of the retail counters or retail sector, listed retail sector in Malaysia actually benefit, right? So if we look at this chart here. If you look at our GDP breakdown, Malaysia's GDP breakdown, our largest percentage of our gross domestic product is actually consumption, which means you and I like to go shopping. And what was surprising is this, right? 2020 is supposed to be a bad year, right? COVID year, right? Our consumption on absolute numbers actually went up in 2020, right? So much for it being a pandemic year. But obviously the stimulus had some effect, obviously, right? Of course, without the 6-month moratorium, I believe that helped. And if you look at stock market participation, you can already see it today, right? But if you look at the consumption pattern, it is going up. So it does make sense for the policymakers to actually do this very broad-based stimulus, because they want it to have that multiplier effect, right? So let's look at maybe some of we're going to zone in just purely on the retail segment today. Of course, it's meant to have a multiplier effect, right? So of course, other sectors will eventually benefit. But let's look at where that first dollar that's going to be received and where that's going to be spent, okay? So, contrary to popular belief, we think that Malaysians like to spend, and we swipe out a lot of credit card. What was interesting actually in 2020, perhaps it was helped by the moratorium as well. Actually, our credit card current balances for 2020 actually fell, right? It actually did not go up. So our consumption went up, credit card balances actually fell, right? These are so the light blue one, personal users, is actually your personal loan, right? So your personal loan has also kind of remained flat as well. Largely, I believe this is because during the pandemic, a lot of banks offered you to convert some of this into a 3-year payment, and to help those who actually have lost their jobs, right? Lost income. Now, in fact, if you look at impaired or non-performing loans over the last 10 years here, 2020, actually some of the stimulus actually did work. 2020 wasn't as bad as we expected. Now, of course, these are really probably very conservative numbers from the banks, which possibly, if these NPLs don't become NPLs and actually do eventually get written back, then the number is less. You actually say in the worst pandemic year, our NPLs are actually lower than we were in 2010, actually, right? Really, I must say, the stimulus package definitely did help the banking sector. I always said that the loan moratorium, everyone was so happy that, oh, I don't have to pay loan for 6 months. If I'm a banker saying, well, luckily I don't have to write down these loans, right? Because there's a loan moratorium, right? Otherwise, my impairment will be even higher, right? So that was kind of a win-win-win situation that happened. And of course, if we talk about retail specific, I've just listed some 15 companies just to give you guys an idea what we mean by retail. Of course, this list is not exhaustive. We talk about specific retail, then you can definitely garner more. But we wanted to give you guys an idea of what we mean by retail counters or retail stocks. Okay. Now, so this is where Benny is going to talk a little bit about where we are in terms of the consumer products and services sector.
Okay, so before we go there, let's take a look at the results of the first poll, right? Well, it's quite interesting here. We have 23% of you guys have already withdrawn, another 13% going to, but 64% are not withdrawing. You guys got a lot of money, right? Okay, we'll come out with the results in the second poll. Right? What will you do with your withdrawals? All right, the additional money what you have. So we'll come up with the results in a short while. Anyway, so since we're going to focus on the retail sector in today's webinar, right? We're going to take a look at the performance of the consumer products and services. What the chart that I have here is basically the index for consumer products and services against the KLCI. So if you look at the consumer products and services, which is the red line, okay, the KLCI is the green line, right? So 2014 to 2018, so the graph that you see over here is this 4-year period, right? So until 2015, you see that the performance of the consumer products and services is almost similar to the performance of KLCI. But moving 2015 onwards, you can see this very big gap, right, between the consumer products and the KLCI itself. You can see the performance of consumer products and services is actually quite strong, right? It's much better than the KLCI performance itself. So that's up to 2018. So that means over the past 3 years, before 2018, the consumer products and services has been performing really, really well. All right. And if you go to the next chart in 2019, okay, this one, it moves quite in tandem with the KLCI, although the consumer products in terms of percentage is still better than the performance of the KLCI. And this is 2019, before we have the pandemic, right? And we can already see the trend is actually going down, but in 2019, the consumer products and services is still in a positive note, right? Whereas the KLCI is actually went below 0%, maybe it has gone negative in 2019, right? Now, looking at 2020, of course, this is where the challenge in consumer products came in. The KLCI fell, okay, in beginning of the first quarter in 2020, right? And you can see that the performance is actually quite similar to the KLCI, right? So the KLCI came down about 24%. The Consumer Product Service Index actually fell about 28%. And of course, when the KLCI rebounded, right, in March, April, the consumer products and services did rebound as well. But of course, it's not as strong as the KLCI. It's trying to play a catch up. So the whole year, the performance of KLCI is definitely better than the consumer products, right, and services. So that was the performance in 2020. KLCI has just barely made out, came back into the black since the beginning of 2020, at the end of 2020. But the consumer products are still in the negative territory. Okay. Now, when we look at 2021 year to date, which is now, okay, of course, the performance, this is from 2019 year to date, right? So if you look at the performance in 2019, we have already seen earlier chart that is negative. It's lower than the KLCI. But what we are seeing now is actually a crossover, right, in 2021, which is this year. Okay, you can see that the red line, which represents the consumer products, is starting to go higher than the KLCI performance itself. Okay, and this all happened since the beginning of this year. So the performance of the consumer products and services are seeing a strong rebound, right? And hopefully that, if things are getting better and it's going to get normal, and if you have seen the historical chart, the consumer products and services index has always been a better performer than the KLCI. So if this trend is going to continue, and it's now just catch up with the index and is now performing slightly better than the index. So what we are seeing here is actually a good rebound on the consumer products and services. All right. I'm not sure whether I have another chart. Okay, yeah, that's it.
Yep. So yeah, okay. So I guess if anything, really we're just getting started, right?
Yeah.
In terms of prices, right? Okay, so let's kind of have a look at some of the segments here. Now I want to talk about the retail industry very specifically. So I put up a picture here, but I'm just curious, how many of you guys have an Android phone, right? Can you just put in the comment section below, right? You're running on Android or you're watching us on an Android device? Yeah. Either the iOS, which is Apple, or you have Android, right, which is run by Google. How many of you guys here actually, just put in the comment section. I'm just curious to see, actually have an Android device, because I'm going to share something with you that you would definitely be interested to hear about. Anyone?
Okay, while the guys are replying, let's just me post the results of the second poll, right? So we have those who are already withdrawn or planning to withdraw. 79% are planning to invest. So I guess the 79% are you probably have a investment strategy to be better than EPF performance, which is 5%, all right? Settled debts 13%, spend 8%. Okay. Well, thank you so much for participating in the poll. We will, from time to time, we'll ask you questions so that you can also participate.
Yeah. Right. Okay. You want to click chat? You want to click something?
Oh yeah.
So a lot of you guys gonna take the money to invest. Okay, so let's see what happens. All right. Either way, it's gonna be good, right? So if you look at retail in Malaysia, thanks to all those who participate Android or iOS, right? Actually, I see a lot more guys with Android here than iOS, right? Anyway, if you look at the global stats, a lot of people are Android because it's free, and some people don't like Apple phones, which is fine. But if you look at Malaysia, actually has posted the worst retail sales in 22 years. Okay, this only just came out in March. Okay, less than 10 days ago. And in fact, if you kind of look at it, what sunk the most, right, was actually departmental stores, fashion and fashion accessories segments, which fell more than 38 or almost 40%, right, in total. When we talk about retail, there are a lot of segments about retail. So we're going to talk a lot about fashion today, right, because they fell the most, right? So the question here is that if they do rebound, is there going to be a very strong rebound coupled with the multiplier effect that i-Sinar might have. Okay, so one thing I wanted to show you guys that was a little bit scary, especially for Android users here today. Some of you may know, some of you may not know. But I think when you click your terms and conditions, actually Android tracks exactly everywhere you go, right? But what they did was actually share something very interesting for COVID, right? So what we're actually seeing here, if you look at this, they actually shared exactly where people go, retail and recreation, right? It says mobility trends for places such as restaurant, cafes, shopping center, theme parks, museums, libraries, and cinemas. And this is Malaysia alone, okay? So obviously you can see it fell up to 60-70% in January. This is as of last week, right? Or yeah, as of last week, we are actually already seeing that increase, right? So what we're actually already seeing is that people are going back to restaurants, mobility trends, right? Mobility trends for restaurants, cafes, shopping center, and so on and so forth, right? In fact, you can see residentials go up, but public transport is down tremendously. So if I kind of zoom in for you, Google is actually tracking you where you're going, and we're actually seeing that uptrend. So if this trend continues, and our Prime Minister just announced today that there will be no blanketed lockdowns, it seems that foot traffic and people are really getting out there into retail or recreation, right? So if this trend holds even to baseline, likely in the next few quarters, and if you factor including the i-Sinar withdrawals for the masses, we're probably going to see some sort of multiplier effect on the retail segment itself, right? Remember in 2020, the consumption did not fall. That is actually quite interesting. Now, so when we talk about retail, I'm going to talk about traditional retail, right? So if people are moving back into the shops, what the traditional retail looks like, right? So this is really a supply chain that I've kind of drawn out just to give you guys an idea, because every business or every case study I'm going to talk about later on will have different spots into different retail on this retail supply chain, right? So if you look at this here, so if I start right at the top here, and if I kind of just kind of use the pointer here, so the manufacturer would actually manufacture the product, right? Or the brand owner is going to ask the manufacturer to manufacture the product, right? Then it goes to the distributor then does the shipping, moves into warehousing, then finally it goes to the retailer. Now from the retail front, you can either be a franchisor or franchisee, and then it ends up to the consumer, right? So think of it, like your typical franchise, right? Now, on top of that, how retail actually works is on consignment, or what they call freestanding stores, right? Consignment, if you think about consignment, very simple. If you go to Parkson, you see multiple brands, right? Those are all on consignment. That's how these retail brands work, right? But if let's say you go to a specific store which is just for that particular brand, for example, then that is called a freestanding store. Okay, so those are just great. I think retail supply chain is actually quite easy to understand. Okay, of course, when we talk about e-commerce simplifies it even more, right? So you have your raw materials manufacturer, or the brand owner gets the manufacturer. You move it to warehousing, your e-commerce platform that buys and sells, and then you have your payment and credit card services, your logistics, and then it ends up at the consumer. Okay, so it's a lot simpler. So the question here is that, of course, e-commerce will always be in competition with regular retail, but it seems that retail, in terms of mobility trends, it is moving there. So with i-Sinar, the question is, will we see an uptick in some of these numbers that we're seeing, right? So we have to understand, when you talk about fashion, they are very, very different segments when we talk about fashion. Okay, so I'll be talking about a couple of stocks that are based kind of around retail fashion. If we talk about mass market, we have to understand it's really, really mass, right? And you talk about Supreme, right, which is very, very pricey, or they call it heritage luxury. Okay, of course they have aspirational luxury and so on and so forth. Now, typically in a very extreme circumstance of an economy, like a depression or a recession, what happens is that generally your mass market gets least affected, and the Supreme actually gets least affected, right? That means the super mega rich, even in the downturn, they're not very much poorer, right? But what happens is the squeeze happens in between, right? Your premium, your accessible luxury, right? People tend to say, look, you know what? Maybe I don't need that Ralph Lauren. Maybe I go to Uniqlo instead, right? Because market economy is doing quite bad, right? So typically the middle part often gets squeezed whenever we talk about a recession. So we're actually going to be talking about a couple of brands that are in the mass market and in that premium segment here. And of course, you guys can decide, right? We think some of them are quite worthy mentions. And how we pick these stocks are very important. Why we're covering these stocks? Because we covered stocks that are in a net cash position, which means that they have more cash than they have more debt. So these are what I call very balance sheet friendly, or very balanced. They've got a lot of money on the balance sheet. So even if there's a downturn, they should be able to survive these downturns, right? So it's very balance sheet. So we're going to talk about 3 counters here today that are in a net cash position. Okay, I just want to mention to you. So the first one is actually PADINI. I think a lot of you guys are probably already familiar with PADINI. So after I just do a very brief introduction of PADINI, then Penny will take over and look at the technical aspects of it. Now, if you talk about PADINI, PADINI is quite an easy business to understand. They are definitely mass market, right? In fact, they are very, very low on the mass market range. So they don't really actually compete with your Uniqlo and your H&M, but not so much, right? They're not really in that price range. Their price range is actually a little bit lower, right? So I think a lot of you, if you have gone to shopping centers, will have seen this PADINI concept store, right? They need no introduction. But really, this is a fairly old company, right? That has kind of evolved over time. Actually started in 1971, I think you can read about PADINI history, but I just want to give you an idea that it's actually been around for quite some time, right? So they actually were listed in 1998. Okay, and I'm gonna give you guys an idea what are the kind of returns that they've generated so far, right? Now, what are some of the brands that they carry? So they don't just carry PADINI. So the PADINI, PDI, P&Co, Seed, Brands Outlet, and of course Vinci, ladies' shoes. Mickey is for kids, right? So they are definitely a mass market product, right? They are definitely mass market. So economy, good or bad, generally they're still there, actually, right? Because if you look at the stats by Statistics of Malaysia, on average, a household spends about 13% of income, 13% of their income on clothing, right? Considered essentials, right? So PADINI, when you see PADINI concept store, it basically takes these 6 brands into one store, okay? And I'll share with you guys a little bit about how this strategy actually worked quite well for them, right? Now, each of these brands have a very specific target market, right? So PADINI is a young exec from 25 to 35. Authentics is college students to maybe a young working adult up to 18 to 25. Seed is for men, women, right? And for kids as well, right? And of course, P&Co is for teenage girls and young women. Now, when you're analyzing Malaysian fashion brands or fashion type brands, we have to understand we are very different from the West, right? Because Malaysia only has 1 season, okay? So we don't have that 4 seasons. So if you guys kind of look up Forever 21, last year or year before that, they filed for bankruptcy. A large part was because when they produce too much of the last season stuff and they can't sell it, it just gets locked down in the inventory, right? So we're quite thankful here that every day we don't have to put on a scarf or to think about whether it's cold or hot, right? Except we're in the office, maybe we leave a jacket in there, right? But generally we're sunny all year round, right? So it's a slightly different perspective. Of course, these are other brands as well, PDI. So these are all where they kind of sit, right? Mickey's for newborn babies. And Brands Outlet is a fairly new addition. Brands Outlet, their business is actually to have no brand, right? Basically no brand. Somehow it's ironic that they call themselves Brands Outlet, but it's really value for money, right? Of course, Vinci is actually footwear and accessories. So remember I showed you guys the report earlier that actually this segment was actually hit the hardest, right? Fashion and fashion accessories, right? Because you're going to be home all the time, so why do you need to buy new shoes and so on and so forth, right? But we're actually tracking that mobility. We're realizing that if we go back to that base rate, we're likely going to see some of these consumption patterns re-emerge again. Now, this is the price chart for PADINI. Of course, Benny is going to go much deeper, but I just want to give you a large overview. Since 2003, they've done really, really well, even up to today. But actually, they've actually today, or this was yesterday's price. Today, I understand they're up about 7%. But they're actually down about 50% from their peak, right? That was in 2018, 2019, okay? So if we look at PADINI as in their supply chain, where do they actually sit, right? So PADINI is a brand owner, which I would say prides themselves to having no brand, because they call it concept store, they call it brands outlet, but when you go there, it's really not branded. You wouldn't want to go there and you wouldn't wear PADINI and kind of show off to your friends that check out my new PADINI shirt, right? That's not the market. They are definitely mass market. So they're brand owner, they're distributor, they own their own warehouses. They are not a manufacturer, so I think we've got to be very clear with that. They operate their own retail fronts. They are a franchisor. They're not a franchisee, sorry. So you can take out the franchisee part. They are a franchisor. So they actually franchise their stores overseas, right? But locally, they own all their own retail fronts, right? And these are some of the brands that they actually own. So this is the value chain that they sit in. They are very clear. They say, I don't want to manufacture anything. I just am a distributor and a designer on it. So they do their own designs and they distribute and they run their own stores. Now, so some of the retail metrics, if you're analyzing retail stores today, and you're hoping to get into, potentially buy a retail store that a stock that is in the retail segment, you must look at growth from what they call same store sales, right? This is known as SSS. Very simple. You don't want to grow your business just because by adding more and more stores, okay? At some point, you're going to hit saturation point. So a lot of retail analysts will actually look at retail stocks by looking at same store sales, whether their same store sales are actually growing, because that will give you an indicator whether they're actually selling more in that same outlet. Okay, real growth lah. Okay, now actually for PADINI, their same store sales actually have been growing in 2018 and 2019. Now, of course, this is 2020, lockdown, can't go out. I think in the early times, you can't even try out clothes, right? So it was actually quite damaging for their business, right? So if you discount 2020 and say, we're going to move back to a new normal and mobility trends are still as is, if they move back, that rebound could be fairly strong, right? Now, if you look at historically, if you look at them, 2018 and 2019, they've actually done fairly well in terms of sales growth, right? If it wasn't for the MCO and the lockdown, they were actually growing quite nicely, right? 2%, 8%, 14% quarter on quarter. So you can see as a business by itself, their business model without COVID or without the MCO, it was still doing okay, right? There was still growth, right? Now, the second thing that you have to understand about the retail segment is this term called consignment, okay? Now, consignment is basically, if I'm the distributor, I put my inventory at your store. So by the time you sell it, only then you pay me back in cash and I'll pay you a commission. That means instead of me just selling my own stores, I will sell it on consignment. So for example, if you go to Parkson or, we're just talking about, apparently Metro Jaya is still around.
Yeah.
Metro Jaya or Isitan, right? You're going to see multiple brands in these departmental stores. Those are all consignment, which means that Parkson doesn't actually carry those, doesn't actually pay for those brands. It's actually still owned by the owner. They're just putting it there for sale, right? And that's how they make money. Of course, if you haven't heard of it, franchise, right? For example, you can also run a retail store from a franchise perspective. That means you don't necessarily need to own a brand, you just run the franchise, right? Of course, the opposite of a franchisee is a franchisor, which means that you give someone the rights to run it using your operations, using your brand and everything, and they run it, okay? So we have to factor some of these factors in whenever we're analyzing some of these retail stores here. Now, if you look at PADINI, they've actually done something quite transformational in the last 5 years. You actually notice that their consignment has fallen quite dramatically from 2015 to 2020. In fact, you can see very clearly they're moving away from the consignment business. Because the consignment business can be tricky in terms of cash flow. And also, if you look at the trends today, I think the concept of departmental stores is probably, it really started in the 60s and 70s, right? When you talk about Macy's and things like that. Of course, none of these big departmental stores exist today. And we're seeing the same trend here in Asia as well, specifically in Malaysia. So what PADINI has done is actually reduce their number of consignment counters quite dramatically. You can see 2015, 16, 17, 18, 19, 20, 20, right? They've just really chopped it all off, right? In fact, what they have done instead, they've actually moved into freestanding stores, their own stores that they run themselves. And you can see one of their main growth drivers or the growth drivers of where their business is was actually, instead of having PADINI, PDI, Vinci and all, they actually created a even low, I would say a more value for money brand, right? Which is Brands Outlet. And that has actually grown tremendously. If you look at 2015 to 2020, right? So they moved away from consignment, which gives you lower margins and lower profits, into their own outlets here. We can see they've grown quite dramatically, right? Of course, they have also cut certain brands like Vinci, they've reduced some stores. PDI also they've reduced. PADINI Authentics also they've reduced. But really that growth driver you're actually seeing is actually the concept store and also Brands Outlet. Okay, so I guess this kind of business is very easy to understand. You just go to Brands Outlet to see how crowded they are. Okay, very easy, and it's very inexpensive, right? That's their target market. So because of what they actually did, I believe that was their strategy. They actually reduced their number of stores from 344 in 2012 to only 174, right? And during this period, if you exclude 2020, when their stores came down, their revenues went up, right? So you actually can kind of see where their strategy is heading, right? So they're actually doing more sales per store, right? They're getting more efficient here. Of course, if you look at PADINI overall, just purely looking at the financial numbers here, I know it look a little bit small, but you can actually download these slides later. But you actually can see that they've actually been continuously profitable for the last 10 years, right? In fact, in 2011, they made 75 million in profit. Before the pandemic, they were up 160 million in profit a year, right? They were doing 1.7 billion in sales, right? So you can see, obviously, their strategy seems to have worked. Reduce the number of stores, move away from consignment, launch a value for money, no-frills brand called Brands Outlet, right? And of course, cash flow has also improved tremendously, right? Now, so of course, minus 2020, so their financial year was 2020, June 2020, and their fourth quarter was right smack in the middle of their third and the fourth quarter was right smack in the middle of the MCO, right? And you can see like their sales dropped, right? Obviously, but I mean, they were still profitable, of course, right? But of course, last year was challenging for all retailers. So what has happened, if you take out 2020 as well, you're realizing that actually their revenues have been increasing, their profits have also been increasing over this period of time. So they're really quite a workhorse and kind of very much proven that their business model works. I guess the question here is that as the vaccine moves forward and mobility improves, right, safe for without an MCO, the question is, do you guys think that their business will really bounce back? Because they are in that value segment and that mass market segment, right? Now, they also are in a net cash position. So you can see they've got, after you minus all the debts and everything else, they still got sitting about 400 million in the bank. So 2020 was really, they had a lot of cash to really survive this. In fact, they more than enough cash to actually survive the pandemic as well. So over to Benny now. Benny's going to share a little bit about price charts with you guys and kind of position where they are today.
Okay, so what I'm going to share with you is the performance of PADINI, right, against our KLCI, which is the benchmark. So we're going to take a look at this particular chart over here. The black line is the price for PADINI. Okay, the red line is the KLCI. So this is since the beginning of its listing in March 1998. All right. So at first, of course, you can see that the performance is almost on par with the KLCI. But as I move along, you'll see that after every correction in the market, you see that PADINI really start to rocket again. All right. Like you see example, so I'm going to move along over the years, right? So in 2016, 2005, you see the price has really shot up, performed way better than the KLCI. And as we move along, you see when the market goes into a correction, of course, most of the share price will start to pull back and go for a correction as well. But like I said, after every correction and when the KLCI start to rebound, you'll see PADINI starts to rocket upwards again. Okay, so this shows how strong the market confidence in PADINI. All right. So even in that 10 years from 1999 to 2009, the PADINI has increased 380%, nearly 440% at its peak, where at that time KLCI was only 93% up. All right. So if I go along, you can see it continues to rocket up. KLCI may go up 5%, but this counter go up like 20-30%. All right. And if you look at the correction again, so the market pulled back for a correction, PADINI did come down for a bit, right, as a correction. But again, once the correction is over, it starts to move, market starts to move again, it continues to skyrocket. All right, so that time KLCI was performing only 137%, but this counter has already gone 10 times the performance of the KLCI since its listing, IPO in March 1998. Okay, so 1,300% returns. I'm only talking about share price performance, haven't included the dividends and all that yet. All right, so as we go along, I'm going to go until 2018 because that's when the market peaked, and that's where our KLCI peaked as well, right? Because after that, you'll see there's a sharp fall in PADINI, like Alvin has shown you the chart earlier, 50% decline, all right? But you just take a look at the performance, right? So again, market went into a correction. So of course, when the price goes up high, the correction will be big as well. So this is from 1,400%, it goes down about 40% in the correction. But then again, after a correction, it goes skyrockets again. All right. So this is a very healthy sign that the market is this counter is very well received by the market. So I'm going to just move forward, right? 2016, 2017 is where it grew exponentially. Okay, a very strong performance. Over the since 1998 until now, the KLCI has only performed 150%, but this counter has already moved now 3,200%. Okay, that's like
30 times.
30 times the performance of the KLCI, right? So that's not the price keeps on continuing to go high. Okay, so in 2018, okay, if you look at the peak, okay, since its listing is about 3,800%. Okay, that's how much PADINI went. All right, and of course in 2018 we see a sharp correction for PADINI. Okay, despite the correction, it is still outperforming the KLCI since its inception or since its IPO in March. All right, so we're seeing a decline in 2019 up to 2020, and of course 2020 is when the pandemic started, right? The COVID-19 pandemic started, but we actually see a rebound in PADINI in 2020. All right, and I believe because in March and April, most of the counters or most of the stocks in Bursa Malaysia has rebounded as well. Okay, so what I want to show you here is basically you can see that over the long run, this company keeps outperforming the KLCI. All right. Even if I look at the short-term 10-year performance, right? Okay, let's take a look at since 2011. Okay, so we know that PADINI has fallen, but over the 10 years, it still returns about 173%. Okay, in terms of its share price performance, but the KLCI is only 5%. All right. Now I'm going to zoom in. I want to see, if I'm going to look at the short term, and of course in 2020, you see that PADINI, okay, 2019, 2020, PADINI has the performance of PADINI is not as good as before. Okay, the KLCI is performing better, right? But if I zoom in closely, you can see over the short term, over the past few months, right? If you look at since early 2020, and especially 2021, you see there's a divergence here. Okay, now up from 2020 until today, the KLCI is still performing better than PADINI, right? Since the beginning of 2020. But if I'm going to zoom in and go closer, you'll find that over the past 6 months, you can see there's a divergence coming on. Okay, especially this year itself, right? Okay, if I'm going to zoom in, let's say just from 2000 or this beginning of this year, you see that PADINI is already starting to perform better than the index itself, right? So over the past 6 months, you can see PADINI is actually performing better than the KLCI. Right, so we are seeing a rebound, and like I said, if everything goes better, in every correction, you're going to expect PADINI to rocket upwards, right? So again, this is not an investment advice. This is what we are expecting based on the historical performance, right? So if the market do rebounds, then we're probably going to see PADINI will be able to climb higher, because what we are seeing now is just the beginning of a reversal. All right, if you are a chartist or a technical analysis, you can really see a double bottom here on PADINI over the past 1 year. All right, and now it's starting to move upwards. So we are really seeing some strong momentum since the beginning of this year for PADINI. Okay, over to you, Alvin.
Okay, thanks for that, Benny. Okay, so look, I mean, we just wanted to highlight a couple of stocks which is very retail centric, and I thought they had interesting questions. Now, these are all companies in a net cash position, so that's really how we actually picked them. Was really not so much about cheap, expensive, or this is not financial advice, but really to really look at if the stimulus is broad based, what's likely going to happen, right? The other notable mention that I do want to highlight is actually this company called LISK, right, or Lee Swee Kiat, right? So they actually sit a little bit higher in terms of the pyramid, and they're not in fashion, right? They're actually a bedding company. That means they make mattresses, right? Now, to be more specific, there are tons of mattresses, you can choose from, right? But they are very specific in a latex-only mattress. That means it's 100% latex mattress. That means it's really, really heavy, right? So, mattresses, you can make it from so many materials, right? Spring, you can put in spring, you can put in pocket springs, you can put in coconut husk, right? It really depends, but they are in that pretty much that premium segment of a mattress. So it's a premium segment, and it's 100% latex. Okay, so that's their differentiator here. So what was quite interesting was actually as of 9 December last year, they actually partner up together with Cuckoo, right? I'm not sure if you guys see all the billboards about Cuckoo. They do water filters, right? They're like a direct selling company. And Cuckoo is actually a Korean company. They are listed on the Korean Stock Exchange, right? And I thought this agreement was actually quite interesting to highlight because it's a mattress company. They are a manufacturer teaming up with a marketing company, right? So where does LSK actually sit in terms of this retail space, right? So they're actually a brand owner. They own this brand called The Pure. Okay, that is their latex bed. You can go and check it out. Okay. They also own the trademark for Englander, right? For Southeast Asia. Okay. They are also a distributor. That means they distribute premium stuff like Stressless and Temper, right? That's something that they distribute. That means they own the exclusive distribution, right? So they manufacture their own beds. They also distribute this high-end furniture. Okay, so they are a bit of a premium segment here. And that's why when you look at 2020, in fact, their results were actually pretty good. They were not so much affected, right? When I mentioned about premium, right? Of course, they also do their warehousing. They also run their own retail front as well. Okay, how they do their retail front? They actually last couple of years they started buying these furniture malls, right? So if you think of MFO or IBG, right? Those are the storefronts that they actually bought to distribute because they wanted to go down the supply chain. They didn't want to just do manufacturing margins. They also wanted to get a piece of the action in the retail segment as well. So that's where they sit. They're a brand owner, they're a manufacturer, they're a distributor, they're warehousing, and they also have a retail front. Okay. So what was interesting about this new partnership that they had with Cuckoo is this, right? They are now selling mattresses as a service. Okay. And how it works is if you call up Cuckoo today, they've got a lot of agents. You actually can subscribe for a bed for 36 months and you pay monthly. What Cuckoo actually does for you is actually they will come and service your bed every quarter for the next 3 years. So you're almost paying a fee for your bed. And I guess the selling point about beds is this, right? The selling point is that, we spend half our lives in our bed. So, why don't we treat ourselves and invest better, right? So maybe some of the i-Sinar money might be going to treating yourself better and buying a better mattress, right? And of course, if you look at mattresses, we might see it as not very often you change it. But if you look at the number of households we have in Malaysia, we have 13 million Malaysians today, and if let's say average 4 household, right, 4 per household, right, you're still looking at one bed or at least two, one bed per person or at least half a bed per person, right? So if you work out some of those numbers, it's actually quite staggering in terms of number of mattresses that one person actually needs, right? And nowadays, if your house, your house doesn't only have enough rooms, right, for yourself, you also have guest rooms as well. So if your guest room also needs a mattress, right? But of course, whether you decide to splurge out on a high-end mattress, that's obviously entirely up to you, right? But it is still very much a necessary thing, okay? So the deal with Kuku is this, right? So they will sell that that mattress. Kuku will sell that mattress on a subscription basis. That means it's a finance thing, and Kuku will guarantee to pay off this bed over 15 months, right? So it's under their guarantee. And anything after the 16-month onwards, what happens is that LSK actually gets 40% of the rental for 21 months after that. So it's quite an interesting business model that I think was interesting to kind of highlight because this happened last year. And as you know, so this was the new thing that they've actually announced. Siti Nurhaliza is actually their brand ambassador for Kuku. It's actually it's a Kuku mattress, but it's actually built by Napure, which is a brand owned by LSK, right? So what they actually do is this, right? They actually do that bed frame cleaning, pillow drying, mattress dry cleaning, hydro cleaning every quarter, right? And every 4 months they come and do it. Now, what is interesting about Kuku is this, right? Kuku actually has they actually have 1 million households that they've serviced since 2014. That means people using their brand, right? Or using their water filter, which they actually need to go and service, right? And it's also based on a subscription service. So, you know, this whole idea is not new to them, right? They're actually quite experienced in this space, especially in Malaysia as well. I know our old office definitely had a Kuku water filter, right? I mean, these guys are great marketeers, right? So this was really the plan, right? The plan is if you want a queen bed, it's only $150 for 3 years, and they'll come and service your bed every quarter, right? If you want a king bed, then it's $180. But if not, you can actually purchase it outright, which includes a year of service as well. So whether you want to go for a subscription plan or you want to pay it outright, okay? I think it's quite a new spin to this kind of industry. It is quite interesting. So if you want to go and do the idea about retail stocks, it's so easy to do research, right? Just walk into a shop, right? Speak to the salesperson, right? I think it's so easy, like, you know, it's almost kind of no-brainer, right, for you to do a little bit of homework here. So really, so these are some of the items that they actually provide, and these are some of their retail brands, right? But I think if you look at the new model they're going for, which is Kuku, that means they use agents to sell the mattresses, and if they already got 1 million households, it can be quite staggering, that number. So when you look at the value or the strength of LSK is this, right? They're actually 100% natural latex, right? That means, they also aniline-free latex as well. So that's something that they are very proud of, and they pride themselves to be 100% latex, right? The other competitor or their closest competitor, some of you may have heard of, is actually Geta or Geta, right? Which is, I guess, a rubber, right, in Bursa. But there are really only 2 players in this segment, so it's actually quite a small segment here. Generally, only these 2 main players, right? So where they are big difference is actually latex, right? So the non-memory foam, it is more premium, okay? It's more premium. So this is their price chart since it started, but their business is quite interesting because it was very much a turnaround story, right, over the last 5 to 7 years, right? And the current CEO actually has took the helm and really kind of turned that business around. They used to do padding for car seats, right? And then they just focused purely on mattresses and building their brand. So if you can see over the last 10 years, you know, their profits have been increasing. They are definitely doing better. They're cash flow positive as well. They also pay dividends as well. So this is their revenue and net profit over the last 10 years. You can see that turnaround is actually happening. And if you look at their margins, their gross margins are quite decent. Their net margins, mostly manufacturing, is about 12 to 10%, right? So we're not really seeing that branding kicking off, right? So I guess the question here is, are they able to improve their margins or increase their volume based on this partnership with Kuku, right? They are net cash today in 2019, so they were able to weather the 2020 storm or the pandemic year. So they are net cash position as well. Recently became net cash 2016. Okay, they are cash flow positive and they have net profit every single year as well. Okay, just to highlight. So I'm going to pass you on to Penny, and Penny's just going to have a quick read on the charts here.
All right, so LISK, Beli Suikiat, it was listed on 2004. You're not mistaken. In July 2004, right? So it was one on the counter which is not really a favorite. You can see the performance of the KLCI, which is the red line, against LSK. So in 2005, 2009, you see the prices were actually going down, right? So over the 2 years, the price actually fell about 80%, and definitely no retail or no investors want to look at this particular counter, right? While the KLCI has returned about 55%. But you can see as I scroll the chart forward, you can see that over the years, even from 2009 up to 2011, the next few years, this company wasn't performing, all right? But if you look at it, KLCI is still going up, okay? But what you're going to see later on towards 2014 to 2015, you see there's a divergence here a little bit. You can see that the gap between the KLCI and the price of LSK or LSK has starting to converge, all right? And then you can see, especially in 2017, and Alvin has shown you earlier, they have actually turned net cash in 2017. And when that report comes out, the price just went up, and you see it just catches up with the KLCI. So from being a negative, right, it's almost down like 90% in its share price since its inception, since its IPO, it is able to recover, right, very substantially, especially in the year 2017, right? The price just shot up, and it's on par with the KLCI, okay, after about 12 years in operations, right? But what's interesting is you can see it continues to grow, right? Of course, there's a correction, but then it becomes a little bit like PADINI. Whenever after a correction, you can see the price just skyrocket again, and it outperforms the KLCI. So like Alvin said, this is like a turnaround story, right? A company which is not loved, nobody knows about, but it's starting to get attention. And if you look at the shorter term, you see that, over the past, even let's say 10 years, right, from 2011, you can see over the past 10 years, actually the counter share price has actually outperformed the KLCI. It's only during its first about 7-8 years when it started to listed on KLCI, it was way below the performance of the KLCI. But over the last 10 years, it has been performing really, really well. All right. And of course, in 2021, you can see the price has also gone up quite substantially. It has really outperformed the KLCI. Even if you look at from 2000 and around November, December 2020, the price has really gone about 50%, where the KLCI has only returned about 2%. All right. So we are really seeing a strong, again, in the short term, there is a momentum I believe, because of the retail sector, right? We have seen it in PADINI. We also see this in LSK. All right. Again, I do not want to do any projection whatsoever. What we basically want to share with you is see how the performance of the KLCI. And I know some of there's a question about why are we focusing on a few stocks, right? But maybe Elvin, you want to mention why did we pick up the stocks? It's not something that we think that is personally is good. We're going to bring it up. There's a metrics to this, lah.
Yeah, so one of the reasons where we looked at a mass scales stimulus that is mass, very, very much a broad-based stimulus, one should assume that immediately your retail segment should be something that may potentially be beneficiary, right? So we went straight to direct retail companies. That means if you got money suddenly, where would you spend it, right? Very much like what happened in the US as well, right? People have free money, where would they spend it, right? So we believe that one of the sectors that will definitely pick up, in fact, it is in the government announcement that they're really trying to restart the economy, right, by giving a lot of incentives for the travel and the tour industry as well. And retail is very much part of the ancillary of that whole ecosystem. Right, so we actually picked out stocks that have been around for a while at least, that are interesting in nature, and of course they are net cash position. Right, that means if there is another lockdown, of course the government has assured us that we won't be another lockdown. They have sufficient cash to survive, because a lot of companies last year didn't survive because they didn't have enough cash or buffer. Right, a lot of companies shut down the moment there was no cash flow. Right, and that's really for value investors. That's one way to be defensive. All right.
Yeah, and I guess it's educational as well, because I think Alvin has also shared like what to look for in a retail a company that is involved in the retail business, right? The franchise and so on and so forth. And of course, we also want to see the whether like Alvin mentioned, how did LIQUIDITY or LSC get into a partnership with Kuku that makes it interesting, right? I mean, these guys are turning something which is boring, like Alvin said, it is something that's so easy to analyze, right? It's right to your face. They only sell bits, right? And these are really serious people who really runs business. Even like PADINI, there's a reason why the financials are good, right? There's a reason why LSK financials are good. So we just want to pick this up so that you guys eventually you'll go and explore further in the retail, because there's a lot of other counters, right? And you can compare these kind of businesses against the other businesses that you want to look at, right? So again, these are things that are very interesting that we find out, and that's the reason why we want to share with you how they actually, what these guys are doing, and also how they perform financially. All right?
Yep.
Okay.
Okay, our last and final one. I hope you guys can hang on a few more seconds. Okay, I will go through this. I think the last one is actually this company called Kim Hin Joo Berhad. I think a lot may not have heard of it. They are fairly newly listed, but if you've heard of Mothercare or the new shop, which is Entertainer, then you definitely would have heard of Kim Hin Joo, right? They run the franchise, right, of Mothercare and the Entertainer as well. So Mothercare is a very, very simple, also very clear market that they serve, right? So we covered one which is purely value for money, practical wear, and then we have one which is your home bedding, right, or something that you sleep on, and the third one is actually babies, right? And it's very much part of life, right? And they serve again a premium segment, right? So they sell strollers and all the other brands I can think of. And I'll share with you guys where they are on the supply chain as well, because they are also a distributor as well. So these are some of the brands that they carry. There's probably too many to mention. I think you can see it. Yep. Is it frozen? Oops. Okay. Is it changing? Nope, that's not changing. Is it frozen? Okay, hang on. It seems like my slides are not changing. Hang on. Oops. Frozen.
Hold on, huh?
Oops, okay.
Okay, let's try again.
Let's try again. Yeah. Sorry about that. We had some technical issues. I don't know why it's not showing. Benny, you want to use yours?
Okay, let me try if I can share mine.
Yeah, maybe Benny can share yours. Yeah. Hang on, we'll get Benny to share his. Okay. Can we get that? All right, cool.
Okay,
Thank you. Yeah, so Kim Hin Joo is basically this. Okay, no, Stephen Patrick, why no Yum Sing counters, right? Like I said, retail is very large, very, very large, right? So, we won't have that 1.5 hours to really cover, but I thought a few easy and notable mentions that that we wanted to kind of look at here. So Kim Hin Joo is very much based around babies and mothers and all, right? So that's really what they do. They've been around in Malaysia for a long, long time, right? Since the 70s, right? So if you're familiar with the brand Mothercare, you definitely have heard of them. They're not just based in Malaysia; they're also based in Singapore. But the listed entity in Malaysia is only for the Malaysian business, right? What you can see about their business is this, right? So baby clothing, from anything from clothing, travel, cots, pram, anything you can think of for baby. And any new fathers here or new mothers here today, I'm just curious, any new fathers or mothers here today, you realize that some of these items can be actually quite pricey, okay? So where do they actually sit on the value chain? So they're not a brand owner. In fact, Mothercare is actually owned by, the brand owner is actually in the UK. So they actually own, they're actually a franchisee, right? They're a distributor, they run their own warehouse, they have a retail front, and they're also a franchisee, right? So they serve a fairly premium segment, because when it comes to baby stuff, that's stuff that you can buy online, no problem, right? So when you think about PADINI as clothes, I think you still need foot traffic, because I think I think Malaysians are still not quite used to just buying online and coming and it doesn't fit and then you have to go and return it. It's just too much of a hassle, and shopping is also something that's fun to do, right? But I think for bigger items like mother care, where you talk about stroller, people will definitely go shopping. They'll try to find the lowest price, right? So they actually serve a niche market who actually wants their service. That means they want to go there and get advice, right? So that's really where their value proposition is. And if you look at the entertainer, it's a toy shop, but it's not a toy shop for kids. It's actually a toy shop for mothers or fathers or parents, right? Because there's a lot of educational stuff in there. So they're very clear of who their target market is. If you want to bring your kids and have fun at a toy shop, Toys R Us would be the place, right? But I think the entertainer is very much catered to the person who's actually going to make that purchase, right? Which is also someone who also shops at mother care. So they've actually done kind of an extension of what they do, right? But they are very much service driven, and they are going for the slightly more premium market. Okay. So they definitely are in the space. Now, who are their competitors? I mean, as a chain, Anaku is probably one of them. Anaku is probably their biggest other competitor. But generally, in this space, there are not many people serving this space. Now, online, plenty, right? You go to Shopee, you can buy the same stuff because they're a distributor as well. So in the physical space, I think the closest competitor will be Anaku. Okay, so if I can click here, so if you look at this, obviously the growth of this business is going to be dependent on the birth of kids in the country. So you can see we are kind of a bit stagnated, but if you really look at the business from birth itself, I don't think that's a right metric to look at, only because if people are having less kids, then the question is, are they spending more per kid, right? Of course, very different from our grandmother's days, right? We have 10, 11 kids, it's not quite normal, right? But I think there's a change in lifestyle, especially urbans as well, right? So really that's really where it is, right? Okay, so if I click here, so if you look at the major births today are generally in urban areas, right? Selangor being the highest in terms of birth rates, right? So if you look at some of the slides that we have here, so Kim In Ju actually fairly recent got listed. Of course, their price is still below the IPO price currently, right? Because they are in the retail segment. If you look at their geographical location segment, they are very much in that Klang Valley, right? And I think they've kind of almost saturated that Klang Valley space, right? So really, I think if anything about this retail segment here, the growth is going to come from the other states, your southern region, your East Malaysia, your East Coast, and your northern region, right? But generally, if you look at the state in number of births, they've pretty much kind of captured that market quite well, okay, already, okay? And that's it. And then I'm going to pass it over to Benny to kind of take a look.
Okay, just a quick one because this company has just got listed, right? Fairly quite new. So I'm just going to show a chart. Hold on there. Share another screen. Okay, so this is Kim In Ju or KHJB, right? So against the index, it has been underperforming, right? Since its beginning, you can see the price initially it went up, but then again it went down, and it went down below the KLCI performance, all right? But what we are seeing, if I'm going to go into again, I'm going to zoom in what's happening over the last few months. I'm going to see whether do we really have a rebound, okay, on these counters, because we did see a strong decline during the pandemic of 2020, right? So if I'm going to again look at it, if I'm going to scroll this, I'm going to simulate this, you can see that the price of KHJB or Kim In Ju is starting to perform better over the short term. So we are actually seeing even in the shorter term, you can see that the performance of KHJB or Kim In Ju has been better than the KLCI, right? So what we are seeing, most of these retail counters, we're really seeing a really good rebound, all right, since the beginning of this year. In fact, since the last quarter last year, and I guess that's when, there are talks about vaccines and so on and so forth, and you can see the pickup rate for retail counters are starting to pick up even in the last quarter of last year. Most of the counters here are retail oriented, right? So like Hongji Wong is asking, why are we using the KLCI instead of industry-related index? Now we want to look at the performance of the industry, in this industry, which is basically consumer products and services, right? And of course, we have zoomed down to retail, right? So if I'm going to compare this with the index, you'll see that it moves in tandem with the index. But what we want to see is against the general market performance, which is benchmarked by the index, how are these retail sector performing? All right, and that's the reason why we use the KLCI instead of the consumer products, because then you will have a same chart, right? Same performance. So all of these three counters, the reason why we brought up is because we are seeing a rebound. All right, we are seeing quite a strong rebound on the retail sector. Of course, here we only look at three counters, but of course there are also other retail stocks that you should be looking at. But make sure you do your enough research to find out whether these companies are interesting enough. Okay, and like Alvin mentioned, the reason why these three companies are highlighted because they have an interesting story, right? If there's no interesting story, then what's there to talk about, right? And of course, one of the main filter that we do is basically these are net cash companies. They have good cash to go through the storm, right? In fact, we did one session last year during the COVID pandemic, start of the COVID pandemic. Yeah. We talked about net cash companies, right?
Yes, correct.
And now you are seeing the results of these things, right? This company that has good cash positions, they're able to survive through the storm, and now they're starting to rebound. All right. So that's for KSJB. Okay.
Slides.
Yeah. Let me share back that slides earlier.
No. Yam Sing counter, I don't know what to talk about, right? It is whatever you, no interesting story. Yeah. I think that's the end already. Yeah.
Okay. All right. So I think that's the presentation that we have today.
Yep.
Okay. So hopefully that you're able to use this as an education or some metrics that you can use to analyze other retail counters. In fact, maybe not retail. The reason why we say retail is because retail is the most easy business, I think, to understand, right? As compared to, let's say, banks, right? I believe if you do the banking sector, we will not be able to finish in 1.5 hours or 2 hours. You're going to last the whole night. Okay, so now this is where you can download a copy of, there are two files you can download, right? Number one is the list of stocks that are owned by EPF, okay, from A to Z, all the counters, so that you have an idea how much exposure that EPF has on these counters, all right? And then a second download is, of course, the presentation slides for today. So I know some of the figures are very small, so once you download the slides, you can see those figures better, right? And again, if you come in late or you come in later in this webinar, you can always view the video back again. So you can come back to our page, Equity Tracker, and then you can see the recorded session, all right? So this is where you can download your slides. Our colleague will put the link in shortly. You can just click and download. Of course, it's actually a Google form. You need to answer some questions first, and then you are able to download. All right, so just go to bit.ly/slides17March. So our colleague has already put in the link. You can just click, and then you should be able to download the slides and also the stocks that are owned by EPF. Okay? All right. So we are open to Q&A right now. We only have a few minutes. In fact, we're supposed to end right now, but we just keep a few minutes for answering your questions. And I believe that most of the questions has already been answered. Yeah. So if you have any other questions at all, can you just type in now? If not, we're going to end this session.
Yeah, and don't forget to mark your calendars. Every third Wednesday of the month, we're going to bring you guys something special. This event is actually sponsored by Affin Huang Capital. So do check them out. So we come up with new and original content and something to keep you as a more informed investor every month. Third Wednesday of every month, right? So it'll be always something interesting, when we hope you guys get something out from these webinars here, right? And don't forget, like and share them, follow our page. Of course, give us feedback if you guys have any feedback. We'd love to hear from you guys. And of course, all these slides and goodies that we've actually churned up for you, it's all available for you. All you do is click on the link and actually download it.
All right. Looks like there are no more questions.
Okay. Maybe the topic's too easy, right?
Okay, great. I guess probably we have presented and most of the answers are already there. Like I said, if you want to view the recording, you can always go back and view the recording together with the slides that you download. Then at least you have easy reference later on. All right. So thank you, Sheila. Thank you for your feedback. Yeah, although it's a 1 hour, 1.5 hour presentation, but it took weeks to actually prepare this session. Okay, the numbers that we actually have to dig in, right? Thank you so much. So if there's no more questions, then thank you very much for joining us tonight. You know, we hope that to see you again in the next session. And please do continue to follow us and on our Facebook, and also give comments on the Google form that, you know, we provided the link earlier, so that we know whether we can serve you better or how we can serve you better. All right. So thank you so much again once for joining us, and I wish you all the best and have a good evening.
Thank you and good night. Bye-bye.